Hi, my name is Marty Straka. I'm a mortgage loan specialist. I've been in the mortgage industry since 1990, handling all aspects of mortgage financing for clients. One of the questions that I often get asked by clients is how much of a mortgage can they qualify for? And the interesting enough answer for that is that they can often be qualified for much higher mortgage than they're actually willing to pay for. And so in many cases, you actually have to go backwards through the process. In order to determine how much of a mortgage you can qualify for, or more importantly, how much you're willing to pay for, you want to take a look at how much income you make. From the lender's perspective, the general rule of thumb is that you can afford to borrow somewhere between 3 times and 4 times what your annual income is. And of course, if there's more than one borrower, then you start to combine those numbers. They use a thing in the mortgage industry called debt ratios in order to determine how much you can comfortably afford and still be able to eat at the end of the day. In most cases, the programs look at what they call a debt ratio, which is how much of your income and how much of your debt relate to each other. So for instance, if your income was $3,000 a month and your debt ratio, or your debts equaled $1,000 a month, that would give you a debt ratio of 33%. In most cases, and for most loan programs, a 33% debt ratio is totally acceptable. Now, the one thing to understand is that mortgage lenders work on a monthly income level, not an annual level. But you, as an individual, you want to know, but how much can I afford? Well, again, if we follow the idea that you can comfortably borrow 3 times what you earn. If you make $45,000 a year, you're going to be able to comfortably afford somewhere in the area of around $120,000 to $130,000 mortgage, 3 times 45. Now, if you're very good at managing your money, and if you've got a good credit rating to show that, you might be able to take your debt ratio much higher, in some cases 40% of your income, 45% of your income, and for certain well-qualified customers, we've even gone up to 50% of your income as a debt ratio. So what does that mean? Well, that means that on that same $45,000 a year income, instead of only being able to borrow $120,000 or $130,000, you might be able to borrow $160,000, $170,000, possibly even $190,000. What really comes down to is how much you say that you can afford to pay each month. We don't know how much you live or how you like to live. If you like to go out to dinner every night, you're going to need to qualify your mortgage quite a bit less. If you are frugal with your money and manage your money well, you might be able to go into a higher loan value to be able to afford a better home. So, my name is Marty Straka. I'm a mortgage loan specialist. If you've got other questions or you want to know more about mortgage financing, feel free to give me a call at 973-598-5006. Thank you.